On Business Incorporated today. Egypt's leather export hit $70, 47 million. IFC partners Angola for agric development. And poor harvest increases import in Kenya. Hello and welcome to the program. I'm Ini John Mekwa. Let's start with trading in Africa. We're trading on the continent kicked off the week mostly positive as observed as intraday Nigeria's main index fell 0.12% while South Africa's benchmark index rose 0.40% as intraday. Elsewhere, Egypt's index also traded higher by 0.21% while Nairobi Stock Exchange closed Fridays with a strong performance. It was up almost 2%. Over to the Middle East now, where sentiments were also mostly in the green at intraday. However, a peep into Abu Dhabi and Dubai markets saw both indexes trading in opposite directions at intraday. The Abu Dhabi index fell 0.36%, while Dubai edged up 0.34%. Still within the region, Saudi Arabia's index climbed 1.13% higher, while the Qatari index rose 0.31%. European stocks rose today as attention shifted from Omicron COVID variant to monetary policy decisions by some of the world's largest central banks. We have Chelsea joining us from Berlin now to give us a broader picture of what's going on in Europe. Well, Chelsea, front and center for global market this week will be central banks, with policy decisions expected from almost all major central banks, the ECB, the US Federal Reserve, Bank of England, and even the Bank of Japan in the days ahead. This seems like a critical week for investors. What can we expect?
It is absolutely crucial, and investors have been calling this the central bank parade. There are about 20 central banks meeting this week, including the biggest ones in the world, the European Central Bank, the Federal Reserve. And the billion-dollar question is, will they start to pull back on that monetary stimulus that has been keeping stocks at record highs throughout the pandemic? Basically, every country is facing, of course, its own unique circumstances, but many developed economies are facing the same conundrum right now. Inflation is running very hot, in some cases at the highest rate in decades, but there's still a lot of uncertainty about the course of the pandemic, especially now that we're seeing another variant force the reimposition of restrictions in some countries. So the question is, will central banks be reacting to surging inflation, or are they going to react to the uncertainty of the pandemic? I think here in Europe, we can expect the European Central Bank to err on the side of caution. Inflation is at the highest level in about 30 years, but we are also in the midst of a fourth wave of infections, and the reimposition of restrictions is weighing on businesses. So moving too quickly to remove that stimulus would put even more pressure on a fragile economy. I think the Federal Reserve in the U.S. is going to take a different approach. They are expected to become more aggressive as inflation there is running at the highest level in 40 years. So investors are expecting the Federal Reserve to raise interest rates potentially by next May. So even among the most aggressive central banks, they are moving very, very slowly, and that is good news for markets and investors that have become so dependent on easy monetary policy from central banks.
Well, meanwhile, Europe has this year overtaken China in creating billion-dollar tech unicorns, a new report shows. And Europe has long been criticized for not doing enough to support startups. What changed?
Yes, that has been a major sore spot for Europe for many years, that it hasn't been producing tech giants to rival Google or Facebook or Alibaba. But there are some signs that that is beginning to change. So according to this new report from the UK venture capital firm Atomico, Europe produced 98 new billion-dollar tech companies this year. In China, they only produced 26 of these so-called unicorns this year. The report also showed that European companies are starting to attract a lot more venture capital funding, so about $77 billion compared to $45 billion for China. There's a lot of different factors at play. I'd say the most significant factor is that the Chinese government has really made it a priority to rein in its tech companies this year, and that has really spooked global investors. We've seen Beijing investigating or fining companies like Alibaba or Didi, and they've also put the brakes on a lot of big IPOs. So investors are definitely worried that if they do invest in China, the government's stricter policies could erase their investment. Meanwhile, here in Europe, the governments have been putting a lot of work and a lot of money into making it a hub for tech startups. So we see this in Berlin, where the government is offering grants for startups that found here. Another benefit is that European startups tend to have lower valuations, so investors still do see them as a good deal. But I will just note that even though Europe has caught up with China, it's still far behind the leader, in this case the United States, which minted about 384 unicorns this year.
Taiwanese chip giant TSMC is in talks to build a semiconductor plant in Germany. That would amount to a big win for the EU, which has made building up of domestic semiconductor industry a major priority. How likely is this to happen?
Well, TSMC made the announcement over the weekend, but they have stressed that talks are still at a very early stage, and whether this actually happens is going to depend on several different factors. For one, whether the government here can offer financial incentives, mainly things like subsidies for TSMC. They'll also be looking at whether there are enough qualified workers here for a plant and whether there's enough demand for a new factory. But both TSMC and Germany have been wanting this for a while. TSMC said in June that it had started looking at setting up operations here in Germany, and the EU, as we know, has set a goal of doubling chip production within the bloc by 2030. So it's been trying to woo not just TSMC, but other global chip makers like Intel. Of course, the backdrop here is that the global semiconductor shortage that has been causing a lot of problems for factories here in Europe and around the world. This did really show Brussels that there's a big risk of being almost fully dependent on other countries for chips. So while there are some European companies that make chips, like Bosch here in Germany, it isn't a major player, particularly in very high-tech advanced chips. So the EU sees that as a matter of not just sovereignty, but also security, because chips are the centerpiece of a digital economy, and Europe doesn't want to fall any further behind in the global tech race.
All right, Chelsea, thank you so much, and enjoy the rest of your day. Well, let's move over to the UK now. There's speculations on changes on the red list as it concerns Nigeria. Well, is this just a wish, or is there any truth to it? We have Juliana joining us now to bring us up to date on that. Hello, Juliana. Good afternoon. So is this just a wish, or is it for real?
Well, who knows? Potentially, though I've got to say, no mainstream media as of yet are reporting this. I think for the UK, there are more pressing issues at hand when it comes to a scandal engulfing Whitehall and Downing Street at the moment. But it is obviously an important story because it affects tens of thousands, if not hundreds of thousands, of travellers from Africa, as you said, particularly Nigeria, who were forced onto the reintroduction of quarantine hotel. There have been some really embarrassing social media videos that have been released over the past couple of days. One of them being, thousands of passengers having to stand outside, no self-isolating between them. They were very, very close, no social distancing, should I say, between them. And also as well, the food has been mouldy and stale. It hasn't been great for the British government. And of course, more importantly, the red list and the fact that only African countries are on the red list has caused complete outrage. The African Development Bank president, as well as the Nigeria High Commissioner to the UK, have both used some pretty strong words to describe how they feel about putting Nigeria on that red list. And going back to the report, Inni, we are hearing that Grant Shapps, the Transport Secretary, over the weekend managed to convince some of his peers in the House of Commons that perhaps if you're fully vaccinated, so there are obviously measures for different individuals, if you are fully vaccinated, then perhaps you will not have to go into one of these mandatory hotels for 10 days at a cost of £2,300 per person, that you may be able to self-isolate at home. But I've got to stress caution, because again, this is purely speculative, and even if these measures are removed, you have to be fully vaccinated. And again, I do believe a couple of months ago, new restrictions were put in place, so not every vaccine that's being administered in Africa has been accepted. But yes, potentially really good news. I'll be keeping my fingers crossed, and hopefully there'll be an update from Westminster imminently.
Yeah, we're certainly very interested in that. And it seems there are more threats to Christmas as we hear talks about wage squeeze for factory workers.
Well, yes, you know, it's a wage squeeze, not just for factory workers, but for households living up and down the country. The report that I've recently read was from the TUC, which is a trade union organisation, looking at the cost of living, which has completely surged past inflation. I believe the cost of living within the month has risen by about 0.8%, and we know that inflation and the cost of living is 1.6% higher. We're still waiting for more data. I believe on Wednesday we're going to be getting inflation data. Inflation currently stands at about 4.2%. There are suggestions that it could go up to 5%. And the TUC have been banging the door on number 11, on the Chancellor Rishi Sunak and the Treasury, asking them for more measures and more support. We know that the £20 uplift on universal credit was controversially scrapped. In the coming year, there are going to be more tax rises, which is going to particularly hurt those that are less privileged. And it is looking like a gloomy Christmas. At the moment, Christmas is still on, but we are going to be waiting to hear from the Prime Minister on Saturday. But again, you know, this is an evolving story, so we'll have more when we receive it.
All right, and how are investors trading at this time?
Not great. The FTSE actually started off in positive territory early this morning. That was helped really by lifting the mining stocks. But of course, the travel and leisure firms are all in the red, not happy. There was actually an open letter written today by some of the big chief execs of UK airlines, well, Irish too, including Ryanair, International Consolidated Group. They're all really unhappy with the fact that passengers have to come back into the UK, self-isolating for 2 days. On top of that, they also have to have a pre-departure test, and they say this is wreaking havoc on the airline industry. They don't want to go, they do not want the Prime Minister to go any further. In fact, they want him to backtrack on some of these new measures, and they're hoping to meet with him later this week. That's affected the numbers. The FTSE All-Share is down 0.06%. The FTSE 100 also down by 0.08%, and the FTSE 250 is down by 0.16%. In the currencies market, the British pound is down on the US dollar by 0.14%, up on the euro by 0.28%, and up on the Japanese yen by 0.06%, Innie.
All right, thank you so much, Juliana. Enjoy the rest of your day.
Thank you.
Let's move to Asia now. Our Asia Pacific market traded mixed today, with some indexes giving up gains as investors turn their focus to a number of monetary policy meetings happening this week in Japan. The Nikkei 225 rose 0.71% to 28,640.49, while the Topix index added 0.13% to 1,978.13. South Korea's Kospi gave up earlier gains and fell 0.28% to about 3,000. Australia's benchmark AX 200 added 0.35% to 7,379.30. Hong Kong's Hang Seng Index gave up early gains and fell 0.17% to almost 24,000. Chinese mainland shares also advanced. The Shanghai Composite rose 0.4% to 3,681.08, and Shenzhen Components added 0.67%. In the U.S. now, futures rose early today after S&P 500 notched its best week since February at a fresh record close, rebounding from a big sell-off triggered by fears of Omicron coronavirus variant. Dow Jones Industrial Average futures traded 90 points higher. S&P 500 futures inched up 0.95%, and Nasdaq 100 futures were up 0.73%. The early Monday action followed a strong week on Wall Street as investors shrug off a hot inflation reading. Investors digested a jump in headline inflation data, which came in at 6.8% in November year on year for the biggest surge since 1982. The print was marginally higher than 6.7% Dow Jones estimate. The key inflation reading came ahead of the Federal Reserve's two-day policy meeting this week, where the policymakers are expected to discuss speeding up the end of its bond buying program. We'll take a break now. When we come back, we have stories from the African continent. To stay with us is Business Incorporated on Channels Television. Yeah, welcome back. You're still watching Business Incorporated on Channels Television. Now, Chad has reached an agreement for a $570 million program with the International Monetary Fund under its extended credit facility. IMF affirms the agreement and notes that the three-year program, seen as crucial to meet the Central African nation's financing needs, allows for an immediate disbursement of $78.28 million. What does this say about Chad's public finance? We have Matt Kindiger, practice lead, sub-Saharan Africa at Front of View, joining us to tell us. Hello, Matt. Good to have you again. Good afternoon.
Having me on the program today.
So what does this IMF package tell us about the state of public finances in Chad?
Certainly. So this is quite a large package that Chad has received from the IMF. It suggests that the country's public finances are under pressure. Chad has been quite negatively affected by COVID-19, substantially more so than most other African countries in terms of the country's economic growth. Chad has been really affected badly by the collapse in oil prices last year. So Chad is quite a large oil producer. Oil is very important for the country's public finances and economy overall. So certainly it illustrates the vulnerability of the country's public finances. But it is worth noting that this is a step in the right direction. Chad has already reached an agreement with some of its bilateral creditors, such as France, China, as well as India and Saudi Arabia in June this year. So certainly the country is in a better position than it could otherwise have been if it weren't for these agreements to stabilize its public finances. So although we are expecting austerity measures over the next 3 to 6 months or the next couple of years as well, certainly the country is not facing an imminent threat of a default or distress in our view. So moving in the right direction.
All right, so this comes just 10 days after a similar package was agreed with Zambia. So it seems like the sub-Saharan African countries, who is likely to go in next for IMF funding from your perspective?
Yes, so Zambia's agreement with the IMF was only 10 days ago, and 3 or 4 weeks ago, there was a similar agreement reached with Tanzania. So this is a trend we're seeing across sub-Saharan Africa where governments are seeking financial support from the IMF. It's difficult to know which country will be next. However, there are a number of large countries in sub-Saharan Africa that we are monitoring here at Frontier View and which we think could be next in line, either for another IMF set of funding or quite severe austerity measures. So Ghana, Angola, Kenya, and Ethiopia are the markets that we are monitoring closely. These are the markets that the World Bank expects to be at the highest risk of debt distress. However, again, it's very unlikely that we will see defaults amongst these governments. And this is because if these governments do face imminent distress, we are seeing trends of governments implementing quite pragmatic austerity measures, and the IMF has been quite forthcoming in providing support. So certainly, there is risk of further austerity, although we don't think it will result in defaults in sub-Saharan Africa over the next 3 to 6 months or so.
So how long do you expect these public finances in sub-Saharan Africa to remain under pressure?
Yes, this is a crucial question because COVID-19 has really blown apart the fiscal assumptions that governments made before the pandemic arose. So public finances in sub-Saharan Africa were already under pressure before the pandemic. but governments were able to keep their heads above water, and this is because economic growth was supporting their ability to service their debts. However, this is no longer the case. We've already begun to see quite extensive austerity measures being introduced. South Africa is a very good example. Kenya has reduced its spending ambitions for the next couple of years. So there's no quick fix, really. We would need to see economic growth accelerate quite substantially to provide substantial relief to economies over the next year or so. So what we expect to happen is fiscal pressures will remain for the next 2 to 3 years. So we are likely to see tax increases as well as spending cuts and more conservative infrastructure investment, maybe until the mid-2020s. It won't be until 2024 or 2025 before we begin to see the very substantial increases in government spending and investment like we saw before the pandemic. So probably another couple of years.
Wow, I guess Africans should tighten their belts. Sounds like that. All right, thank you so much, Matt, for bringing us up to date and giving us some details on Chad. Enjoy the rest of your day.
Thanks very much. You too.
So moving on now, the United Nations has ranked Zimbabwe as the worst country in the world in terms of trade openness. UN agency United Nations Conference on Trade and Development gives Zimbabwe a lowly 3% behind Cuba and Iran. Trade openness measures flexibility and accessibility to foreign investors. And in Ghana, the country will charge airlines $3,500 for every passenger flown into the country who isn't fully vaccinated against COVID-19. That's part of a push by the West African country to avoid a fresh wave of infections. Carriers that take vaccinated passengers without negative PCR test results into Toka International Airport will also be fined starting from tomorrow. The Ghana Health Services and Ghana Civil Aviation Authority said in a joint statement. We move to Egypt now, where Egypt exported leather and leather products worth $70.47 million in the first 10 months of 2021, and that's a 63% year-on-year increase from $43.22 million in January to October of last year. The Leather Export Council of Egypt, LEC, released figures showing that in October alone, leather exports soared by 55.8% year-on-year to 7.11 million from 4.57 million in October 2020. And in Angola, IFC and Corino Group, Angola's biggest food processing company, have launched a training program for tens of thousands of farmers and small and medium-sized enterprises engaged in Angola's agriculture sector to help them increase productivity and more easily access markets. Through the program, IFC will help Corino Group develop sustainable agriculture practices, including conservation and crop diversification, and establish value chains in rural markets with a focus on soybean cultivation and poultry farming. And despite a huge market potential for thermal coal in the region, local miners are finding it hard to export due to excessive costs of transportation. Recently, Zimbabwe's coal miners obtained temporary permits to export excess stock that are built up due to low uptake by the power company. And in Kenya, poor harvest is expected to increase demand for cross-border imports of food. Data from the Ministry of Agriculture indicated that Kenya accounted for 58% grain traded by East African countries by July and September 2021. During this period, Tanzania contributed the most in exports, accounting for 57% of total export to Kenya, while Uganda exported 117,319 metric tons of maize to Kenya and South Sudan. That's it on the program today. Thank you so much for being a part of it. I'm Ini John Mekwa.